Lights, camera, action. For those of you living under a rock, here's a quick recap. Trump is your new president, winning the popular vote for the first time in 20 years as a Republican. Chair Powell had to cut 25 basis points today to keep his job.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Nancy Pelosi just got elected for her 20th term, and the reflation trade is back underway. Let's roll the tape. Welcome, everybody, to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks held onto gains from yesterday as investors digested a fresh interest rate decision from the Federal Reserve, Donald Trump's electoral victory, earnings, and some key data we got today. And that all led us to tech leading the rally today, led by, again, semiconductors, Nvidia, AVGO. We're also seeing a bit of a rally into Nvidia's earnings next week, I believe. We also saw a rally in Microsoft, Apple, software names, just the broad tech sector rallying. Everything from the cyclical side of tech to communication services. It was a broad-based rally in the tech sector. However, we didn't really see the same type of broad strength in the rest of the market. Financials were really weak today. So too was industrials, as well as defensive names, energy, utilities, staples. But it was a very mixed bag. If you were in the right stocks, you definitely did make money. Look at stuff like Eli Lilly, up 2% today, but the J&J and AbbVie were down to flat. So if you're in the right stocks, your portfolio did well. If you were in financials and the wrong stocks, it didn't do so well today. And the best performing sector by a mile was the XLK, the technology sector, followed by XLC and then the XLY. This is really the magnificent 7 sectors, with the S&P 500 performing 0.79% on the day. A very strong day. And then real estate in the fold, and this has to do with the Federal Reserve's decision that we're going to talk about, as well as yields. Yields moved tangibly lower today, and real estate directly benefits from that. And that's why the real estate sector was up 1.24%. Now, we also saw gains in healthcare, materials, staples, and utilities, although not as much as the S&P 500 or the Magnificent 7 names. And then we saw declines in energy, industrials, and financials were the worst, but they were very strong yesterday. And I think this was just a bit of profit taking, the market giving some back. I wouldn't take this with any significance other than the fact that's how markets work. We go up, we go down. But after the financial space rallied like 6 or 7% yesterday, we're just giving some back, a bit of profit taking. It is what it is. That's how markets function. And looking broadly, we saw gains in core and growth across the small, medium, and large size segment. The biggest gains coming from the large growth segment, and then value across the board saw declines, with the worst declines coming from small cap value, but only down 0.63% after yesterday's 5.53% gain. So net, just a bit of profit taking, guys, and that's all that price action really was today. It was profit taking and just a continuation from yesterday, particularly in some of the bigger names as well as the broad indices. It was very constructive price action today, coming off yesterday, if you ask me. And we saw this in the market breadth technicals. Guys, look at stocks above their 5-day moving average. For the record, this is the S&P 1500. This is not just the S&P 500. This includes mid, small, and large caps. 80% of stocks are above their 5-day moving average. Almost 70% of stocks are above their 20, 50, and 100-day moving averages. And then we have 66% above their 150, 64% above their 200-day moving average. Very strong market breadth. Like, breadth momentum is extraordinary right now. It's absolutely crazy. And this type of breadth growth momentum is just the market pricing in three things: deregulation, tax cuts, and inflation. But let's look at some of the market movers today. Fortinet reported earnings up 3% for the day, down 4% in after hours net, but a 1% loss there. And their earnings, in my opinion, was actually blockbuster. They beat revenue by a wide margin, beat EPS by a lot. GAAP EPS expectations was for 44 cents, right? The management board reported 0.7 cents. They raised their full year revenue guidance, but maybe so much was priced in for the stock to come down in the after hours. Because I looked at their earnings, I read over everything. I thought it was really, really good. I thought it was really constructive, but obviously the street is seeing something there. I'm not. That being said, down 4.4% in the after hours, and we'll see how it reacts tomorrow. On the flip side, Airbnb reported very mixed results, in my opinion. They just beat on EPS, missed on revenue, by the way. The stock was up 16% though in the after hours. Absolutely wild move. And even though they did slightly miss revenue, they still grew year over year. Revenue was up 10%, gross profit up 25%, operating income of 1.25 billion. The guide was pretty good, and that's why we saw the stock rallying 16%. But the truth is, going into this earnings for Airbnb, there wasn't much in expectations, and that's why we're seeing the huge move up. Whereas Fortinet, the stock had huge expectations going into it, and that's why despite the great earnings we saw, the stock is down in the after hours. So it's all about perception and expectations and what management guides for. Now, earnings wasn't the only market mover today. We also had initial jobless claims. It pretty much came in flat, a slight miss, inconsequential really. US productivity also with a slight miss, but it's not a market moving event. What really did move the market today was the FOMC rate decision. Now, the Fed cut rates by another 25 basis points, as you can see right here. The Fed funds is officially in a range of 4.5 to 4.75%. Guys, we've had 75 basis points worth of rate cuts this year. Absolutely crazy when you think about it. By December, I think they're going to cut again. We're going to have a full 1% worth of rate cuts in 2024. That's very constructive. Now, I'm not going to bore you with what Jerome Powell said, and I'm just going to tell you the number one key thing we need to look out for after this FOMC, and I think it really has to do with the Fed cutting rates and the move the bond market has made since the first Fed cut in September. And pretty much Jerome Powell came out and said that the move higher was more likely driven by better than expected economic growth, not because of principally higher inflation expectations. So in other words, the move higher we've seen in the 10-year and 30-year yield since the September cut, the Fed believe it actually has to do with a stronger economy. And that's what they think, and that's what they're reacting to right now. So it doesn't matter what we think, that's what they think, and we do have to work with that. So the Fed believe the move higher is because of a stronger economy, as well as the election, I guess, a little bit sprinkled in there, but largely a stronger economy, not higher inflation expectations. Powell later added that for higher bond yields to impact the Fed's policy, they would need to see material changes in financial conditions that last and are persistent, and they're not seeing that right now. He also mentioned that the election will have no near-term effect on their policy. He says, "We don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects would be on the economy." So they're not really looking at the election. They'll take it step by step, month by month as it comes. That being said, this is actually relatively bullish. The Fed are in a cutting cycle. We got another 25 basis points worth of cuts, and I think we're going to get another in December. But let's hop on the charts. Markets were very bullish here today. The S&P 500 and Nasdaq 100 up 0.74 and 1.54%. The Nasdaq 100 a huge move. And again, I think leading up into Nvidia's earnings, we're going to see more of the same. The IWM was down 0.35% today. The entire yield complex was down significantly. Volatility fell, the dollar fell, and as a result, commodities absolutely rallied. Silver up 2.6%, gold up 1.8% today. Bitcoin up 0.74% after yesterday's 9% rally. And pretty much we saw an everything rally in all asset classes except small caps and mid caps. That was really, they just gave some back after yesterday's big move. Stocks, bonds, commodities all up today. Even look at the TLT up 1.25%. very strong move. And we also saw some big changes in the gamma positioning for the S&P 500. Now, another new all-time high here for the S&P 500, and that's also a new all-time high for the advanced decline line. So market breadth looking exceptional, market technicals looking exceptional. And by the way, guys, we nearly hit this core resistance nearly at the 6,000 level in the S&P 500. We saw a gap up and go and another gap up and go today, although a little bit selling on the highs here with this week, but we also did see that yesterday if you do look closely. For the rest of November, I do see more downside back to the gamma flip than I do see upside. We could go ahead and touch the 6,000. Maybe the market wants to see that before the end of the week. I favor a little bit of digestion into November's OPEX, and then we continue the rally after the November OPEX into December. I didn't think we would actually see this big of a move. I thought this type of move would only come like in the middle of November, but we take the market as it comes. We were positioned ahead of this regardless. And so I do think we're going to see a little bit of downside, maybe some digestion in the market, and then we'll continue the move higher, probably closer to the 6,100 area to finish off the year. We'll see how that plays out. But right now we closed at 59.73. The gamma flip moved up ever so slightly. So did the put support. We are in positive gamma, and that means any dips we do get, we want to buy those dips because structurally and technically the S&P 500 looks very, very strong and just poised to go higher. This looks incredible, guys. This is just higher highs, higher lows, new all-time highs. That's very, very strong market momentum. To be honest, right now, this is the new higher low. So even if the S&P 500 was to pull back, break the gamma flip, and then pull back into the put support, that would still be a higher low. And on a technical level, the S&P 500 can then move back up to the 6,000 level. And even if we take a measured move, and let's take a measured move and just say we had to fall out the sky, right, and have a bit of a pullback, it would take us a 3% pullback to actually get to the put support, and it would take full nearly 4.75%, nearly 5% to get back to these lows right here. Absolutely incredible momentum. So the S&P 500 looks very structurally sound at this very moment. If we do break this level, there's not a lot of support up until these lows right here. However, we're long beyond that, and we really shouldn't look at falling out of the sky. What we really should be looking at now is opportunities to get in. And I do think that if we do pull back to this 58.75, if we do see a bit of digestion over the next couple of days, couple of weeks into November's OPEX, take that opportunity to buy the dip. I do think we're going to finish the year between the 6,000 and 6,100 area. It's been a great year, and there's a lot of tailwinds for the S&P 500 right now. Rate cuts, the election is behind us, earnings, buybacks, and so much more. But looking at the Nasdaq 100, new all-time highs, the core resistance, if the core resistance doesn't move up tomorrow along with the gamma flip, do expect material downside tomorrow, because that's normally what happens. The core resistance is a very, very strong line of support. But based on the strength we're seeing in this market right now, it all depends on what the Nasdaq does. Now, yesterday we did actually see at the 22,000 level the core resistance, so that could move up there. There's a ton of volume up here. So I do think the market, especially Wall Street, could see like a 22,000 Nasdaq very, very soon. I'm not talking in the next couple of months. I'm talking maybe in the next quarter or two. But there was definitely some very weird options activity that we saw in the market yesterday. And looking at the RTY, we saw the put support and gamma flip move up. The gamma flip was here yesterday. It moved up. As long as the RTY holds the 2350 area, we pull back, find support, and then go from there. It definitely moved higher. We are seeing some upbeat action here in the after hours, and there is still quite a lot of room to run to get to the upside target of 2445. So the IWM can actually move higher, but I do favor a little bit of digestion, maybe a little bit of a pullback, and then a move higher. I think that's kind of normal. We did start to see that in the IWM, but we'll see how that pans out. Nonetheless, all of these indices look really, really strong, guys. You don't want to fight the trend. We're positioned in small cap qualities, names like Paycom, PayPal, Google, MOAT, the Nasdaq 100 as well. So, we got a broad-based exposure, got a little bit of gold as well. And all we want to really do now is just hold. And while you're holding, build cash positions, dollar cost average. That's what you want to do in this type of environment. We're in a bull market. The best thing that you can do is do nothing. Just hold. And when you have the opportunity to buy, get in and do it swiftly. Looking at the RSP, this looks very constructive, guys. And markets are literally just holding their highs, their new all-time highs. You love to see it. That's a new wick all-time high for the RSP. It's exactly what you want to see. Let's have a look at the gold chart. Now, constructive buying, and that's a very, very strong level. Why? Because it's just another higher low. We probably go take out these highs in gold. The reason why gold was down yesterday had to do with the dollar, and the dollar has pulled back. We'll see what happens with the dollar. I'm not really sure what's going to happen with the dollar. There's a lot of conflicting opinions that I have. With the Trump presidency, you should see a materially higher dollar, but I don't know what that looks like. Is it the 106 level? Is it the 110 level? Is it the 103 level? I don't know where that equilibrium level is for the dollar, but we'll see how it pans out. Nonetheless, do expect a materially stronger dollar throughout the next 4 years, and maybe even structurally higher yields because the deficit will widen. That being said, it's good for equities because the market is pricing in inflation, rate cuts, and deregulation, and that's very, very bullish for stocks, all things considered. So buy dips, buy the gamma flip if we do get there, the S&P 500 and the Nasdaq 100 and the RTY as well. We are in a bull market, guys, and we are poised to go higher into the end of the year. With the election behind us, we do have to start looking ahead as to what's to come. And normally a typical presidential election year after election day sees stocks rally quite significantly. Then we go through a period of digestion, we put in a higher low, and then we continue the rally and the move upward. This is the case also in every other year in the S&P 500. We do see a Q4 rally, and that Q4 rally officially kicked off after the election. And normally Q4 rallies, especially in election years, are supported by the VIX, the volatility index, falling. Volatility and equities typically have an inverse correlation, and volatility falling means equities go higher. And we do see volatility elevated into the presidential election. Once we get the certainty, like we have, Trump's going to be the president, volatility subsides, equities tend to move higher. And this also tends to happen in the month of November. We see a surge early in the month, then we see a digestion period, a period of consolidation. Then towards the 20th, 21st, and 22nd of November, we put in a higher low and normally rally up, breaking the highs we made here earlier in the month. And the average November return is slightly above 1.8%. Very solid gains right here. So guys, if we do see consolidation and digestion for the next 1 to 2 weeks, this is seasonally what we should expect. And investors have also been recalibrating their interest rate bets ahead of the Fed's meeting. Now, in early September, the market was forecasting 8 rate cuts by the end of 2024. With the Trump victory, the market is now actually pricing in 4, and that is why we're going to see structurally higher yields. But you do have to understand that the path for the Fed fund is lower, and that should result in the overall yield complex moving lower, although the longer end can be stubborn. However, we are going to keep a keen eye on what yields do. And even though higher yields do signal a stronger economic backdrop, the cost of capital is higher. So we do have to play our cards right here with small caps. You don't want to be too overexposed to them. And with higher yield comes a higher dollar. And a stronger dollar is bullish for defensive stocks, while weaker for cyclicals, particularly materials. You can see comm services and materials, stocks with highly diversified international revenues, tend to suffer on a stronger dollar, whereas domestic producers, staples, utilities, and healthcare tend to benefit from a stronger dollar. However, earnings growth is overshadowing the rise in yields and the dollar because tax cuts are margin and earnings accretive, like immediately to that tax year. And particularly for small caps, the sensitivity of earnings per share to a 1 percentage point change in the tax rate for the Russell 2000 is 1.2%, meaning that if the tax rate, which is currently 21%, was to fall to 15%, like Donald Trump has promised, we should see anywhere from 6 to 8% earnings growth in the Russell 2000 above the current expectations pretty much every year for the next 4 years. For the S&P 500, you're looking at 0.9 to 0.8%, a 1 percentage change in the tax rate. So you're looking at about 4 to 5% increase in earnings per share. That's if we get the full tax cuts from 21 to 15%. And the truth is the GOP has potentially House control, and they definitely have Senate control as well as the executive branch. branch, so they probably can get these tax cuts through. But regardless of where you are positioned, you should see a positive earnings impact across US sectors. And this is coming on the back of what is already very strong earnings. For Q3, we've seen 7.8% earnings growth, 5.1% revenue growth. This compares to the analyst expectations at the start of earnings season of 4.7% and 4% respectively, and margins also coming in better than expected, with the best sectors actually being comm services, tech, healthcare, and financials on the earnings front, as well as the revenue side. Very, very strong, robust growth, robust earnings, and this is technically going to get better, assuming we get the tax cuts that the market is anticipating. Overall, this bodes really well for stocks and the financial markets. But let's actually talk about the macro. Fed's GDP now, the fourth quarter tracking estimate, ticked up to 2.7%, so growth looking very, very robust. I want to see what this looks like after we get some of the data points later this week. I think we could see very close to 2.7, 2.8% by the end of the week, but it really depends on how the economic data comes through. And as of late, the economic data has been very, very strong. The economic surprise index has actually rallied to almost yearly highs, signaling investor and market confidence in the US economy for 2024 and 2025. And something else we're seeing is the IPO barometer is pointing to an improving backdrop for IPO activity. The anticipated 20% rise in M&A for 2025, with strong economic growth and CEO confidence as the drivers. IPOs are expected to increase, though high valuations remain a constraint for private equity and venture capital firms. So we are seeing an uptick in IPO activity. We'll see if this does pan out in 2025, but we are officially above the 100 baseline. This is where we were in 2020 when there was a huge IPO activity, and this is just going to be super, super bullish for regional banks, banks as a whole, stocks as a whole, companies with huge balance sheets, huge cash balances. This is going to trickle through the economy, assuming we do get that IPO resurgence we are expecting. And looking at earnings for the rest of the week, there's not much here on Friday apart from Sony, and then the big data points are all behind us. The election, FOMC, we just have University of Michigan sentiment tomorrow. The consensus expectation is 70 there. The forecast is 70.6. So we'll see if sentiment comes in better than expected. I do expect it to, especially with this Trump victory, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.